G'day and welcome to this week's video. My name is Robert Gowdy and I'm from Consortium Private Wealth in Horsham. Recently we had a call from a journalist who was doing an article on superannuation default funds. And what he was doing is comparing a default fund within a superannuation plan. Now just so you know that a default fund is if you start with a new employer and you do not pick where your superannuation money is to go, you automatically go into one of these default funds. So he was comparing default funds with other funds that you could pre-select yourself if you were to make a choice, and found that some of the returns within the default funds were doing substantially better than the pre-select options. And he was wondering why this might be. When it comes to investing, the main driver to your returns is the asset allocation. What amount of the money is invested into either Australian shares, international shares, property, and then conservative assets like cash, fixed interest and so on. The more amount of money that you've got invested into the growth components, the property and the businesses, the shares, and the least amount in the conservative assets, over the long term you're going to get a far better return over your investment in lifetime. So it really depends what we're comparing, and quite often what a lot of people do will compare a balanced fund. So every fund has a balanced option there, but the variation in asset allocation within these balanced funds is substantial. So over 5 or 10 minutes I did some very quick research on this issue and found within one balanced fund, within an industry super fund, it had nearly 85% of its asset allocation within growth, Australian international shares and property, and only 15 to 18% conservatively invested. Where in another industry fund I found another balanced option, which could be the default option, that had 50% growth and 50% conservative assets. So I know over a 3, 5, 10, 20, 30, 40 year time frame that the fund that's got more growth allocation will do substantially better than the balanced fund which has more conservative assets in it. Given that asset allocation drives results and returns over the longer term, and we know that having more growth investments in our portfolios, whether it be superannuation or in our individual names or whatever entity we choose, what we do need to get used to is the more growth we have, so we know we're going to get a higher rate of return, we need to accept that there's going to be more volatility. So if we know that asset allocation is the driver to returns, and we want higher returns as we all do, we need to understand that we need to put up with short-term volatility if we're going to have more growth assets within our funds, our superannuation assets, or our other portfolios. And we need to understand that short-term volatility, when we're investing for the very long term, is not risk. And I think this is one of the key things that I speak to my clients about, and educating them that in the short term, share markets will go up and down relentlessly. That's what they do. They've always done that, they always will. And that's because of the liquidity. These things trade every day. So everyone's emotions, fears and greed is all played into these markets. So we will get short-term volatility, but we need to understand that short-term volatility is not risk, particularly when we're investing for our investment. Our investment time frame is very long. And a good example of that is I'm age 48. All going well, I get to 88 in really good health. I'm a 40-year investor from here. I may retire at 65 or 70, which is obviously a shorter time frame, but when I retire, I will not be retiring my money. That will still be invested, and that's something I intend to do in my retirement, is continue to have the fun of investing and researching businesses for the rest of my life. Yeah, try to be as much like Warren Buffett as possible. That's the thoughts on default funds. There's nothing wrong with them, but I think what you do need to do is look at your superannuation assets, and you need, or any of your investments, and look at the way that's invested with a mind to your investment time frame, and understanding that short-term volatility is not risk. Thanks for listening. We'll see you next week.